As the world's second-largest economy, China's financial health reverberates across the globe. But a looming threat has economists and policymakers on edge: the country's volatile real estate market. For over 2 decades, China has grappled with massive housing bubbles that have defied conventional economic wisdom. But what's really driving this phenomenon? And could it be the key to understanding China's push for de-dollarization? In this exploration into China's property market rollercoaster, we'll explore the causes, potential solutions, and global implications of these persistent bubbles. All sources referenced are included in the description below for further reading. The story of China's housing market is one of dizzying highs and nail-biting lows. In the early 2000s, as China's economy boomed, so did its real estate sector. Cities like Shanghai and Beijing saw property values skyrocket, with prices rising by an estimated 25% annually in some areas. Fast forward to the 2020s, and history seems to be repeating itself, with housing costs in major cities once again reaching stratospheric levels. But what's fueling these massive bubbles? And more importantly, can they be deflated without bursting the entire economy? The roots of China's property market frenzy run deep. In the late 1990s, the Chinese government began encouraging private homeownership as part of its economic reforms. This shift coincided with rapid urbanization and rising incomes, creating a perfect storm for real estate demand. Local governments, heavily reliant on land sales for revenue, were all too happy to feed the frenzy by releasing more land for development. As property values soared, speculation ran rampant. Many Chinese citizens viewed real estate as the safest and most profitable investment, pouring their savings into multiple properties. This mindset was reinforced by cultural factors, such as the importance of homeownership for marriage prospects. Before we delve deeper into the causes and potential solutions, I want to take a moment to encourage you to engage with this content. If you're finding this analysis valuable, please consider liking and sharing this video to help others understand this complex issue. One of the most striking aspects of these bubbles has been their resilience. Despite government attempts to cool the market, prices have continued to climb, defying predictions of an imminent crash. This persistence has led some economists to question whether traditional bubble theory applies to China's unique economic model. Professor Shang-Jin Wei of Columbia Business School offers insight into this phenomenon. China's property market doesn't follow the same rules as Western economies. The government's ability to intervene and control the market creates a different dynamic that can sustain high prices for longer periods. This government intervention has taken many forms over the years. Measures have included restrictions on multiple home purchases, higher down payment requirements, and property taxes in some cities. However, these efforts have often been offset by stimulus measures during economic downturns, sending mixed signals to the market. The consequences of these bubbles extend far beyond the housing sector. China's real estate market accounts for a significant portion of the country's GDP and household wealth. A sudden collapse could have devastating effects on the economy and social stability. Moreover, the property sector's outsized role has led to concerns about misallocation of resources and reduced productivity in other sectors. So, how can China address this seemingly intractable problem? Experts suggest a multi-pronged approach, diversifying local government revenue sources to reduce reliance on land sales, implementing a nationwide property tax to discourage speculation, developing alternative investment options for Chinese savers, gradually deflating the bubble through controlled price decreases. However, each of these solutions comes with its own set of challenges and potential pitfalls. The delicate balance required to manage a soft landing for the property market highlights the complexity of China's economic situation. Interestingly, China's housing market woes may be playing a role in its push for de-dollarization, the reduction of reliance on the US dollar in international trade and finance. As China seeks to insulate its economy from external shocks and assert its global economic influence, a more stable domestic financial system becomes crucial. Dr. Ezra Prasad, a senior fellow at the Brookings Institution, explains the connection. China's efforts to internationalize the renminbi and reduce dollar dependence are partly motivated by a desire to create more stable domestic financial markets, including the property sector. A stronger, more independent monetary policy could give Chinese authorities more tools to manage asset bubbles. This brings us back to our initial question: can China tame its wild real estate market? The answer remains uncertain, but it's clear that the outcome will have far-reaching implications not just for China, but for the global economy as a whole. As we've seen, the causes of China's housing bubbles are complex and deeply intertwined with the country's economic model and cultural factors. Solving this issue will require a delicate balancing act between maintaining economic growth and preventing a market crash. The stakes are high. A successfully managed property market could pave the way for more sustainable economic growth and bolster China's efforts at financial reform and global economic leadership. On the other hand, a mishandled bubble could lead to a crisis that reverberates around the world. As China continues to navigate these treacherous economic waters, the global community watches with bated breath. The outcome of this high-stakes economic drama could reshape the international financial landscape for decades to come. In conclusion, China's housing market challenges serve as a stark reminder of the complexities inherent in managing a rapidly developing economy. As the country strives to maintain its economic miracle while addressing structural imbalances, the world would do well to pay close attention. The lessons learned from China's experience could prove invaluable as other emerging economies face similar challenges in the future. Whether China can successfully defuse its property market time bomb remains to be seen. But one thing is certain: the outcome will have profound implications for the global economy, geopolitical power dynamics, and the future of international finance. As we continue to monitor this situation, it's clear that the story of China's housing market is far from over.